Welcome to the Daily Update, where I'll go over the action in the market for Thursday, February 15th, and then we'll see how things look for Friday, February 16th. Had another up day. Predictably, we're starting to see some extreme positive indications, especially in the short term, a few in the intermediate term. We didn't fall all that much. We worked off some of the extreme condition that we had been seeing, and now that we're going back up, we're starting to see that again. At the same time, in Thursday's session, we saw the small caps and the mid caps do really well. We saw the mega caps lag behind. The S&P lagged a little bit as well. It was still up on the day, but it was kind of encouraging to see more of a broad market participation. So let's go back and talk about what happened. Right at the open, we had a higher open and prices climbed up to R1 at 5,017. Then we fell back to the unchanged level, that usual thing that happens. We're kind of filling the gap here. And that, in this case, acted as support. Then we climbed fairly steadily over a period of time back above R1. We got up to R2 at 5,033, and we closed slightly under R2 for the day. We were up 0.58%, but volume continues to be below average. This is a bit of a concern. And on the big down day that we saw on Tuesday in reaction to CPI, that was above average. But the days that we're going back up, we're seeing volume really trailing off. And that's not necessarily a positive thing. We have to follow price, as always. That's ultimately the main indicator. But these are things that we can look at under the surface to suggest that there's not an awful lot of enthusiasm right now. But some of our smart money indicators are suggesting that they're still in there buying. So you can kind of balance this back and forth. Our technicals are positive, looking a little extreme positive. We're going to get another reading on inflation and a pretty influential report in Friday's session. PPI will be coming out, and we're also going to get consumer sentiment. So that hopefully will help some of the picture overall. We want to keep an eye on all the different geopolitical events. Small caps, mid caps, and the broader market did outperform in Thursday's session, and that was kind of encouraging. Tuesday's CPI decline has now pretty much been recaptured, especially when you look at the S&P 500 chart, and I'll show you that with the intraday chart. Everything that we lost in Tuesday's session, we're now back at that level again. And then it was earlier in the week, we heard that Japan has now slipped into a recession because they have had negative GDP for 2 quarters in a row. Now the UK is starting to slip into a recession. The debate is still going back and forth whether the US is going to slip into a recession or not. You can make a case for either side, but so far the market is still anticipating a soft landing. On a short-term basis, we have the Williams percent R, the CCI 14 and 20. These are now on the list because we've been moving up. And our stochastics chart, which has been there for a while now, it's still there. We have the standard deviations chart. We're right on the border between the +2 and +3 channel. The rate of change going back 50 periods, that's a new one. The Sean trend meter is looking a little more extreme. And now with the update with the NASDAQ 100, the bullish percent index is crossed back above 70. The Chaikin oscillator, we're keeping an eye on our different oscillators here. They're looking extreme. Some are looking a little more negative. Some are still looking positive. And for some reason, I have the Sean trend meter on here twice. And then we have the boom indicator that measures how far away we are from the 50-period moving average. Long term, we went up, so our 150 and 200-period moving average studies are now looking extreme again. But the parabolic SAR is still negative. We're going to need to see more of an advance for that to switch back over positive. We're still dealing with this scenario, and I have another chart to show you that May is pretty much being taken off the table right now. But it looks like the Fed is done raising rates. They pretty much have stated that, and they're either going to keep rates the same or cut them at some point in the future. And now that's what the market is trying to figure out. When is that going to happen? The dollar was up and interest rates were down. We have been dropping. And the fall in interest rates is being attributed to helping the small caps and mid caps to do better in Thursday's session. With the 10-year yield, we are now at 4.24%. We still have the yield curves that we've been following that remain inverted. Sentiment is still positive. We're at 73. We're just getting up to that 75 range. We're just a little bit below that now. Our trend is positive, but we are below the moving averages, both with the short and intermediate term. But since we're above 20, we are in a trending environment. Our bias is positive and our momentum, I'm still keeping mixed to positive with more of a positive slant right now. We'll have to see how the market reacts ahead of the weekend, which will be a holiday weekend as well. And we have PPI coming out. We had a whole list of economic reports. I don't have all the charts for all of these. I just want to go through and hit the big ones. Retail sales, this came in weaker than expected. And that kind of helped boost small caps and mid caps. And it helped keep the S&P looking a little bit more positive. They expected retail sales to be down, but only down 0.2%. They were down 0.8%, or last time they were up 0.4%. When you take out autos, also down 0.6%. They expected it to be up 0.1%. Last time it was up 0.4%. And the retail sales are such a massive, anywhere from, I've heard 40 to 70% of the U.S. economy is driven by retail sales. So even at the low end of what you hear as estimates, it's still a very important part. Weekly jobless claims, they actually ticked down. They expected 221,000. They came in at 212,000. So we have weak retail sales, but we're looking strong still when we look at the employment situation. Continuing claims were at 1.895 million. Import prices were up 0.8% month over month. When you take out fuel, they were up 0.7%. Export prices were up 0.8% month over month. When you take out agricultural products, they were up 0.9%. I had to extend this to another page here. The New York Empire State Manufacturing Index, it was at a minus 2.4. That's actually better than the minus 9 they had expected. Last time it came in at a really low number at minus 43.7. The Philadelphia Fed Index also better than expected at 5.2. They expected it to be down minus 9. Last time it was at a minus 10.6. Total industrial production came in down 0.1% month over month. They expected it to be up 0.4%. Last time it was up 0.1%. Capacity utilization did tick down. They expected it to come in at 78.9. It came in at 79.5. Last time it was at 78.7. So we're still under that 80 level when we take the whole reading. And when you look at this on a year-over-year basis, industrial production is now unchanged, and capacity utilization is down 1.1%. Business inventories did come in as expected, up 0.4%. Last time they were down 0.1%. The NAHB Housing Market Index came in at 48. That's greater than the 46 they had expected, and up from the 44 we saw last time. Here's a few charts. Here are the core retail sales. And this is showing a year-over-year decline, but we're still above zero. And month over month, we did see a decline where they actually expected it to go up. And that was a bit of a shocker to the market. Industrial production, that's the blue line where it's coming down, but it's still above zero. Capacity utilization is flattening out here, and it's still looking positive for right now. But as I said earlier, it's still below that 80% level. So we're still not quite up to full utilization of our capacity. Then here, this is looking at this where it has been declining, but we're still below the 80 level, and we're above this 78 level here. And industrial production did decline on a month-over-month basis. Here are the weekly jobless claims where they continue to go down, but the moving average is still going up. So we're seeing a little bit of a contradiction there. With the continuing claims, both are now starting to go back up. We saw it tick down last week, and then it came back up, and so that's keeping our moving average going up higher. Here's what we look at everything together, and it may be a little hard to see with this. The red line is the initial claims, and the blue line are continuing claims, and then we have the most recent unemployment rate listed on this chart as well. Here's a couple of charts. This is looking at a seasonally adjusted basis. The S&P 500 margins are on track to continue rising into the fourth quarter when you take them all together. And so this is just showing that things are improving that way. So this is still holding up and justifying stock prices being higher. And they ask, what's the biggest risk in the market right now? And that's the dark blue area, which would be for February. Most people are fearing that inflation is going to kick back in right now. And then there's other things that people are worried about, but inflation is kind of the big one. This is where we're looking at the probability of a rate cut actually occurring in May. They dropped March off the table. Then they started to look at May. And as we see this declining, that means May is now being taken off the table. But this came out. This is an Isabel Net blog chart. This was before the retail sales report was released, so it could adjust. Here's our intraday chart. We had a higher open. We made it up to R1. We came back down to the unchanged level. And then we saw kind of a sustained move up, back above R1, all the way up to R2. That set the high for the day. We trailed down a little bit and just ended up closing slightly below R2. Here's our intraday chart. We didn't really see a lot of action in the initial overnight session. And then when Europe opened, we did see a real bump up in the futures that carried over into the cash session. Here's the advance that we saw, and we're trailing off just a little bit in the initial overnight session. This is an area that showed some weakness where we're seeing the red line back above the blue line now. That means value outperformed growth according to this chart. We also saw a decrease in our growth to value ratio intraday, where it went down right off the bat and pretty much chopped sideways after that. So we're not seeing that solid improvement, at least in Thursday's session. Here's our end of day chart where growth was up, but barely compared to value being up. Growth did outperform for the mid caps, and it was up, but up less for the small caps. So looking at our small cap growth to value ratio, we tick down when you compare the two with each other, but we have been seeing a really nice breakout here. This might be following through into the index itself, but you notice we're coming up and we haven't got back to the high that we set back in 2023 yet. Folks are really gun shy with the small caps right now. We see a couple of good days, and then the next 3 or 4 days end up giving a lot of that back. So we'll be waiting to see if there's more follow through this time. We also declined with our mid cap growth to value ratio, but this has been seeing more of a sustained advance. And we did break out above the 2023 high for right here. So that's showing a little bit more strength. We declined a little bit with our growth to value ratio for the S&P, but overall we have been going up. We're still working off of a downtrend when we compare the ratio, but the longer that we can stay above these lines, the more we might see a golden cross here. Keeping an eye on discretionary to staples, showing some improvement, finally breaking out above this previous high here, and starting to do away a little bit anyway with this negative divergence that we had been seeing for quite a while. So this chart is showing some improvement across the board. Here's our trend where we're still falling below the moving average. The green line's on top and we're getting close to that 40 level again. We're actually a little bit above 40 with the short-term chart, but we're also below the moving average. And we're continuing to drop off with volume. And that's you can see as we're going up here with price for the most part, we're seeing this oscillator continue to go down. And that's also a negative divergence. Keeping an eye on sentiment, have a few additional charts here. This is real investment advice. We did get the active asset managers reading, and I usually go through that in the weekend video. This tries to match up when we had extreme readings and then what the S&P was doing at that time. We are getting a pretty high reading since these folks are emotional as well, even though they're professional money managers. Then here it's looking at corporate sentiment, where it's looking a lot better than it had been looking. These are people inside of these big companies, and they tend to start, according to this, they're feeling better about how things are looking right now. The Ulcer Index didn't really change all that much. It's still giving us a pretty low reading. With the update, we declined with the VIX on the line chart as well as the bar chart, but we're still above the moving averages. And we're also ticking down a bit when we look at the VIX of the VIX. We're dropping a bit below the moving average with the bar chart as well as the line chart. And that's usually what happens. When we have an upward movement, then volatility tends to back off or decrease. The equity put call ratio continues to decline, and our 5 period is also continuing to decline. We want to keep an eye on this, though. If this keeps really going down, we could be getting to an extreme reading where at some point when we bottom out and start to go up, that may mark some kind of a top in the market. We're keeping an eye on the correlation between the VIX and the S&P. We're now coming back up and getting another extreme reading. This also tends to be more negative. If you look back at the times that I mark here on the chart, most of the time the S&P, at least on a short to even intermediate term basis, saw some weakness after that. We're still getting a pretty high reading with the skew index, where the market is still anticipating some kind of a move. We're looking positive technically, but yet we're seeing things kind of line up that a real decline could be in order as well when we look at seasonality and what we're looking at by measures of the VIX. So we'll have to wait to see what price actually does to confirm whether it's an upward move or a downward move. I showed this before. I just wanted to keep this on here for now. We're also looking extreme positive with the Investors Intelligence latest reading. And we did get another reading from the American Association of Individual Investors. They actually ticked down a little bit, and they're not looking extreme. We also follow the red line here, which is above zero and advancing. And we can go with that for right now because they're tending to be more positive on things. They're not really extreme at this point. There's another thing that you may be hearing about from time to time. It's a thing called the Hindenburg omen. Of course, it's the famous Zeppelin, the blimp that we call them. When it exploded, I think it was 1937, when it was getting ready to land and it blew up and the humanity and all that stuff. The perma bears love this thing. And I found out about this decades ago when the research first came out, and I did some research on it, and I'm not a big fan, but some of you may be hearing about this. The perma bears that talk about this, they present it as though this is fact. But when you look at the actual statistics, when this kind of a signal is generated, it's got about a 25% success rate. And that's based on the research that I did a long time ago, and Investopedia also did some research on that. So here we go. I'm not going to read through this. This defines what the Hindenburg omen is over here. And this is one of the perma bears that you tend to hear about. And these folks also use a lot of Elliott wave. And no matter what's going on in the market, they always draw a downward line for stocks and an upward line for gold. This gives a little bit of a description, and this is kind of the takeaway from Investopedia. It was reported that it had correctly predicted a significant stock market decline only 25% of the time. That's not good enough for me. 75%, it didn't help us, and it was wrong. I mean, that's worse than batting averages in the major leagues. I mean, at least they're right 30% of the time, and you can still fail 7 out of 10 times. So where my kind of takeaway with this, I don't have charts about that because I don't think it's that important. So, and believe me, the different perma bears that I pay attention to, when one of these things hit, they tell you because it's like party time for them. This is their version of Valentine's Day. And so we know that they're going to be happening. I don't have charts to actually show you of that, but it says it's not always correct, but it may be used with other forms of technical analysis to decide when it's time to sell. That's kind of my attitude as well. Okay, we know one of these is hitting now. It's a negative thing. The perma bears think this is the end of the stock market as we know it. Well, the reality and the more practical way of applying this is, okay, it's there. Let's look for other things that are also starting to look more negative as well. That's where I come out on it. Let me know if you agree or disagree with that. All right, looking at our advanced decline line, we are showing some improvement and starting to break out based on price. We're not quite breaking out yet based on volume, but we are seeing an improvement here. We're seeing a real expansion of the new highs and really no new lows, and we're just barely starting to turn up, but we haven't crossed above the moving average with our 5 period. We are starting to turn back up with the 10 period. We are above zero and advancing with the advanced decline ratio. And with the cumulative NYSE advanced decline line, since we had the upward move, this is looking healthy for right now. We're also seeing an improvement with our regular advanced decline line for the NYSE. This is also starting to break out, but we haven't cleared some of these previous high points, at least yet. Accumulation distribution. This is a smart money indicator. This is still looking pretty good. Now, the fact that this is positive, that's one way to look at this. The fact that we're kind of getting far away from the moving average, and I've tried to set up an indicator that measures the distance, but with stock charts, it's just really not all that possible. We could be getting kind of far away from this and suggest that we might be due for a revert to the mean kind of a thing here. We're also looking positive with the chicken money flow. That seems to be holding up for right now. And we're starting to go back into a little bit more of an extreme reading with the chicken oscillator. Here's showing an improvement with the red line with the NYSE advanced decline line compared to the S&P. So we're showing an improvement with the common stock NYSE. We're starting to break out with the S&P. We're also starting now to break out with the mid caps above this previous high. We still have a ways to go, but we're improving when we look at the small caps. Here's our daily chart. We're still watching this trend line. And if we start to break below that, so far this level has held. And if we really start to look to close below that, and then we'll also be watching the 20-period moving average if that happens. In the meantime, if we keep going up, that's just going to make the chart look even more positive. On the bottom, we are dropping below average with our volume there. We're keeping an eye on the 20-period moving average. We haven't really tested this again since we tested it in Tuesday's session, but if we do start to fall, we'll be watching this level. We did show a bit of an improvement with our 20, 50, and 200-day moving average study. We're showing some improvement in getting back up to the midpoint with the force index, looking extreme in the short term, trying to turn up after being extreme positive in the intermediate short term, rolling over still in the long short term for the stochastics. Here's where we're right on the border between the +2 and +3 channel for our standard deviations chart. We're looking positive and possibly getting up to this black line with the balance of power, but not there yet. Here we're turning back from the wider shade of pale to a darker shade of blue now with the go, no-go system. That's turning more positive again. And we're coming back up, but not quite up to the blue line, which is the highest high value. We're above the midpoint, which is continuing to advance. And here's another darker shade of blue again, where this is actually looking a little bit more negative, and it's been kind of chopping back and forth a little bit with the TTM squeeze. We are showing some improvement with the ease of movement. We're still above zero. We're flat with the Erin indicator after being extreme positive. We're seeing some improvement here with the McClellan oscillator for the S&P. We've now spent a couple of days above zero, so that's helping the summation index start to turn back up based on price. We're also starting to turn back up based on volume. So we're seeing more of a confirmation now with that. The NYSE McClellan oscillator actually showed more improvement because the broader market did better. So that's above zero. So we're starting to turn back up based on price and volume with the NYSE summation index. We're above zero and advancing with the Swenlin trading oscillator based on price and volume. This is where we're seeing some real contradictions. The PMO is extreme positive, but it's still dropping below the moving average. We're just barely crossing above the moving average now based on price. We're still flat when we look at this based on volume. But when we look at our PMO studies, we did see an improvement with the PMOs that are rising, turning back up slightly with the buy signals. And after showing more of a sustained decline with the PMOs above zero, this is barely just starting to turn back up. And we went from being neutral the last couple of days to looking more positive now with the Elder's Impulse system for the S&P. The dots are still on top with the parabolic SAR. This is just a guess on my part, but we would probably have to take out the previous high for this to turn back more positive. And then here's our oscillators, where we're extreme positive, but we're below the moving average and declining. The MACD also right on top of the moving average. So all of them together in the short term, we're looking a little bit more negative, but we're still extreme positive. We're rolling over with the MACD, the PPO, and the PMO. We're now starting to roll over with the TRIX and the KST longer term. We're still above all of these moving averages in our moving average tree. We ticked back up slightly with the bullish percent index for the S&P. So that is positive, and we're not necessarily getting an extreme reading. If this can continue to go up, that would be more positive for the market. We ticked back up just a little bit with the NYSE bullish percent index, and now we're back above 70 again with the NASDAQ 100 bullish percent index. So that is now back to being extreme positive. We continue to be positive with the money flow index after being extreme positive. We're going back up with the ultimate oscillator. We're going back up with the vortex, and the green line is on top. We are advancing with our RSI and not extreme, at least yet. The on-balance volume is still above an advancing moving average. We're showing some improvement here with this longer-term negative divergence. When we look at the 200-day moving average study for stocks in the S&P, also saw a bit of a bounce with stocks above their 50-day moving average, but we're going to need to see more than what we're seeing right now for this negative divergence to be negated. The Copic curve is still dropping below its moving average, and we're starting to get a little bit near the extreme reading for the Sean trend meter. We're not extreme with the boom indicator based on 20 periods. We still have a ways to go. We are looking more extreme when we measure how far we are away from the 50-period moving average, and we're still continuing to show some improvement when we measure the distance from the 200-day moving average. So we're turning back and looking a little bit more positive with the Heiken Ashi. The Kegi chart is pointing back up. That's positive. The Renko redrew again here, but it's still looking positive. And the 3-line break is back to looking more positive. We're still above this longer-term trend line. We want to watch this to see if we really start to decline. Is this level going to hold? We may go all the way down to 4,000 or something. It's where we close. That's going to be the important thing. And then here's our longer term moving average study. We're extreme with the 150 and 200 simple moving averages. This is a new chart that I just put on here. It really isn't telling us anything now. I just wanted to show it to you. This goes from the October low up to the all-time high, and then these are some fib retracements. If we really start screaming to the downside, we'll be watching this. Of course, if we go back and set another new all-time high, this will have to be adjusted. Then we're still looking positive across the board when we look at the Keller market model. And here are the alerts that were triggered. We just had the NASDAQ showing a little bit of weakness, but then it got that right back. Everything else here was positive in Thursday's session. The equal weight actually is outperforming the S&P a little bit right now. That's better for the broad market. So we're coming down when we look at our ratio between the S&P and the equal weight S&P. The Dow came right up to this R1 level. So this is acting as overhead resistance. Even though it was up 0.91%, the diamonds have gone from being negative to neutral back over to positive now. And we did break above this R1 level again with the NASDAQ. So that's showing some improvement. And we're filling in this gap that we saw back in Tuesday's session. We're also breaking above the R1 level with the NASDAQ 100. So we're starting to break through some overhead resistance. We still remain neutral, though, when we look at the QQQs for the Elders Impulse system. We're still looking negative when we look at the momentum for the NASDAQ 100. And the small caps coming back up above this R1 level, not back to the high set in 2023 yet, but we have reclaimed the 50-day moving average. And Thursday was a good day. They were up 2.4%. And we've still remained positive with the Elders Impulse system for the small caps. We're still above this resistance level now. We've now spent 2 days above it, but we haven't reclaimed this previous high yet. We're looking better with the RSI. We're also in a longer-term uptrend, and the momentum is now turning back to positive when we study the Russell 2000 small cap ETF. The mid caps did close above this R2 level, so they're starting to break upward support or resistance, and we're positive with the mid caps when we look at the Elders Impulse system. We didn't set a new all-time high in Thursday's session, but the FANG index was up. The financial sector is still looking good for right now. We're keeping an eye on the New York Community Bank. It was up just slightly in Thursday's session, so it's at least holding together for right now. The dollar is still showing some improvement. It was up slightly in Thursday's session. We may be coming back and generating a golden cross here if we stay above these moving averages. We were down with the 10-year based on the yield. We were up with the 10-year based on price. And then looking at growth of value, not a lot of changes here because we saw the broad market really outperform. We're just about on the moving average when we look at the Qs to S&P. We did see a little bit of an improvement here with discretionary to S&P, but we're still below a declining moving average. We turned down, but we're still above an advancing moving average when we look at large cap growth versus large cap value. So we turned down a little bit with the large caps. Didn't see much. We ticked down just a little bit with the mid caps. And we're still looking pretty strong right now, even though we declined with the small cap growth to value ratio. We're still positive when we look at the 5-day moving average of the new highs minus the new lows for the broad market. And we continue to decline when we look at the Staples to S&P 500 ratio, which is typically positive for the market. So what's our outlook for Friday? We're positive with our technicals. We're becoming overbought again, and we're wondering, is this period of weak seasonality going to take hold at some point? We're going to get housing starts and building permits. That tends to be a leading indicator, and we're going to get PPI, and that's going to be the big report in Friday's session. We're also going to get consumer sentiment, which can be influential. We want to watch all the different geopolitical things that are happening. And then here's the economic calendar, and I'll have the new one for next week. Seasonality, we're pretty much across the board here with different results. The Dow is flat out positive, where the S&P is neutral to positive, or the NASDAQ is neutral to negative. So we're not getting an awful lot there. This will be the last week of options expiration, where we tend to be up more than down for the entire week. Here's another chart put out by Carson, where it says late February can be tricky for the bulls. I don't know how tricky it is. If it's going down, you're losing money unless you've shorted the market. But this is just trying to give us some evidence that now that we're getting up into the middle part of February, we tend to see some weakness going forward. We also see that in this chart as well, and that also carries over into the mid to latter part of March. We see a little bit of that here with the Stock Traders Almanac when we look at the green dashed line. Also, when we look at when the sitting president is running for re-election, we also see some weak seasonality going into the middle to latter part of March. February does tend to be the worst of the best 6 months, even during an election year. Friday is the second most positive day of the week. So on the positive side, we have that going for us. We'll be on the 12th trading day of the month, where we're seeing a little bit of positive seasonality here during an election year for the S&P. And then here's Tom Bowley's research, where he takes the whole month together. It tends to be bearish. And we're starting to enter into that period of time where the seasonality may really kick into gear. So, and take that. And then looking at our scenarios, not going with the down one at least yet. If anything, we would still lean to the upside, even though we are becoming overbought again, even though we have this historical weak seasonality that is lingering in the background, even though we are seeing a decrease in volume as we've been going up. We want to wait to see confirmation based on price, and then our charts will tell us if things start to turn negative. We're not going with the sideways trend, even though we're in a weakening trending environment. We're still in a trending environment, and that trend is positive. The warning signs, volume has been decreasing as the S&P has been going up. The risk-on posture is not helping us. Our oscillators are extreme positive and dropping below their moving averages, and we're starting to see some longer-term negative divergences that have been developing. The McClellan oscillators and summation indexes, they're turning back up, but they're still in the bigger picture diverging from the S&P 500. The parabolic SAR is still negative. The Copic curve is also negative. The NASDAQ 100 bullish percent index, it's positive, but it's now back above 70 again. And momentum for the NASDAQ 100 is showing weakness. Small and mid caps are negatively diverging from the S&P when you take their indexes. And the discretionary sector is showing some improvement, but is still negatively diverging from the S&P. The transports, not showing those charts. I'll show them over the weekend. It's still showing a negative divergence, not only to the Dow, but also to the S&P. And then stocks are entering this period of historical seasonal weakness. Now, that doesn't mean this has to happen. It's just when we take the last number of years and crunch them together, this is usually a weaker time of the year. Positive signs. Growth has still been holding up, but it didn't really show a lot of strength in Thursday's session. The S&P 500 oscillators are extreme positive and starting, well, you can't get much more positive than extreme positive. And the equity put call ratio is still going down for right now. The vortex is positive. Small and mid cap growth is positive and continues to hold up, at least for right now. The financial sector is positive. So our conclusion, we're positive, but we're becoming overbought again. And we want to at least respect the idea of weak seasonality. In the short term, that's really what we're watching for. In the intermediate term, we're becoming more overbought. In the long term, we are overbought now because our 150 and 200 period moving averages are looking extreme positive. Thank you. I really hope you found this helpful. Have a really good day, and I will talk to you in the next video.